Hello everyone, hope you're doing fine. So today we are going to deal with the third part of the first chapter of the economic survey, economic outlook, prospects and policy challenges. I'm Rahul Bhatia and I've already done the two parts. Please look in the YouTube videos, and also the videos are there in the economic section of our video lecture in our website. So let's move ahead. So today we are going to deal with the aspects of inflation that is given in the economic survey. So what is inflation? Inflation is the sustained rise in the general price level. Sustained rise means for a long time. It is not like yesterday the price of onion increased by 10 rupees, so you will call it an inflation. Inflation is sustained over a long period of time and of a basket of goods. We don't take only onion, we take a lot more goods than that, and we measure it through indexes. So what does economic survey says about inflation? It says that if the government accepts the recommendation of the seventh pay commission, and it raises a question that would it destabilizes the prices and inflation expectations. So you might be considering that the seventh pay commission will be pumping a lot of money in the economy, and inflation happens when there is pumping of money, when more money is given in the hands of the people, and here the government sector is giving a pay hike. So it is obvious, you will feel it is obvious or but natural that it will lead to inflation, but the economic survey says that most likely it will not, and it also gives us the reasons. And before that, it shows us the graph, and in the graph we have a inflation which is measured by indexes CPI and WPI. You know CPI, what is CPI? CPI is consumer price index, that is a basket of goods and services which reaches to the consumer, at what price it reaches to the consumer. Okay, so it says that at the sixth pay commission time, that is 10 years before this year, 2006, after, when we see that the year on year growth of the wage bill was huge. Are you seeing here? There was huge year on year growth, but inflation, if you see measured through CPI, it didn't rise even after sixth pay commission. And I should tell you that sixth pay commission was segregated in two parts. The first set of pay hikes were given in September 2008, and second set was given in August 2009. And even after the second pay commission, it didn't hiked, like the hike was not there in the inflation. So what does it mean? That the inflation is independent of the hike of public wages given in the pay commissions, you can say that. So even if fully implemented, the expected wage bill under the seventh pay commission will increase by 52% only when we compare it to the last pay commission, that is the sixth pay commission, where it was, the average wage hike was 70%. So when in the last pay commission the hike was, the inflation was not there, how can it be this time? So it was giving reasons that why the hike will not happen. First reason is only public wages increase. In principle, inflation reflects the degree to which aggregate demand exceeds the aggregate supply. Obviously, when the demand will be more, the supply will be less as compared to demand. So the prices will rise because many buyers will be buying, will like to buy a particular product, and will be agreeing to give more money for that particular product. And these pay awards determine only one small part of aggregate demand.
In fact, they do not even determine the government demand, and the government demand depends on the overall fiscal deficit. Now, fiscal deficit is net commercial borrowings of the government, and the government demand depends upon the overall fiscal deficit, which is the difference between how much is how much the state is injecting into the economy through overall spending and how much it is taking out through taxes. By the government, what does the government do? It spends money also in the various social sector schemes, in infrastructure, in research, and various other expenditures. But it gets its money through taxes and through earnings by providing various services. Okay, so the fiscal deficit is difference between how much the state is injecting in the economy. When the state is injecting more into economic than the state is earning through taxes, obviously it will take the money through loans. Okay, so that is the fiscal deficit. So since the government remains committed to reducing the fiscal deficit, the pressure on prices will diminish in spite of the wage increase. Are you getting that? The pressure on prices will diminish because the government is demanding less. So the government is demanding less, so liquidity is available in the economy. The pressure on prices will decrease. So that said, the theory does suggest a sharp increase in public sector wages. A sharp increase in public sector wages could also affect inflation if it is spilled over into the private sector wages. If the public sector is giving more money than the private sector employees might agitate and demand that please give us more money because we also want to earn same as the public sector. But actually it is not so. Till now the public sector employees earn much less than the private sector ones. But after the 7th pay commission, it can happen that the public sector employees can rise above par than the private sector. So private sector may demand the money. Private sector employees may demand the money, but currently this thing is muted or diminished because there is considerable slack in the private sector labor market. So it is there is considerable lack in the private sector labor market. As we can see, the rural wages are very low, and even if private sector wage increases, nonetheless it quickens somewhat. The existence of capacity underutilization suggests that firms might find it difficult to pass on the cost increase to the consumers because the demand is less. Okay, and the companies are producing their products much less. Suppose they can produce 100 beds or 100 machines, but they are producing only 70 machines because demand is less. And if they increase the price on top of that, the 70 demand which is fulfilling 70 machines might reduce, and people might wait for the prices to decrease. So the private sector can't increase the prices even. The other fact can be the impact of increase in the HRA. When the 7th pay commission is applied, the HRA will increase, but the economic survey says that this effect will likely be modest, that it will increase consumer price index between 0.15 to 0.3% only. Now I will tell you little bit about CPI and WPI. WPI is wholesale price index and CPI is consumer price index. It is at the factory level, it is at the consumer level. WPI, the main components in the basket of WPI is manufacturing goods, food articles, and fuel. Food articles comprises approximately 20% of it. In CPI, approximately 50% is contributed by food articles, and then there is health expenditure, etc. So CPI is more towards the domestic or the lifestyle of people. The WPI is more towards the industries. Okay, so let's move ahead. What are the other factors that can influence inflation? The other factors can be a year of below potential growth. Suppose in the next year we get less growth, so it will mean that the output will also be less. When growth will be less, when demand will be less, the companies will produce less, so the economy will slow down. So as a result, there will be less inflation, because people, the companies will try to woo the customers by reducing the prices, and the prices has already fallen below the 5%. Now the next point is the monsoon. If the monsoon is very good, okay, or it is a normal one, the food prices will ease. Obviously, when the production is more, demand is less, the prices will not hike. The other factor can be oil prices, which have plunged and which are very low for past 1.5 year, and it is expected to be low, and it will likely be contributing to very low input prices, because the most of the prices of transportation as well as the machinery which requires oil, etc., will be very less, and thus will further hinder the inflation. And also the most important factor, the growth in China continues to slow down. China is very widely intertwined with the other economies of the world. If if China slows down further, the Chinese factories which are having excess capacities, as you know, China follows export-led growth model. That is, its exports decides its growth. So if the Chinese factories are not finding the markets, it will start exporting at low prices to India, which will further put downward pressure on the prices of tradable goods around the world. Not only India, around the world, the Chinese will compete by reducing the prices. And the other benefit is it can be partly offset or partly shaked by the depreciation of the rupee. Now, what do you mean by depreciation? Suppose in $1 at a particular time, the rate is in $1, the rate is 50 rupees. Suppose if it becomes 70 rupees in $1, we can say that that rupee has depreciated, because it has lost 20 rupees. That $1 can buy 70 rupees of things now. Okay, so if this will be proved to be a boon to exporters, because when exporters will supply the same thing using raw materials in India, they will get $1. Previously they were getting only 50 rupees as the exchange rate conversion. Now they will be getting 70 rupees. So they will be very happy to export, and they will produce more. Okay, this will bring in the foreign exchange in our country. So this will further bring the inflation to the downside. Upside, but it will be countered by Chinese import. That is China, which is exporting to India. Now, tightness of monetary conditions. Tightness of monetary conditions can be defined as the difference between the base rate and the nominal GVA growth. Now, what is the base rate? The base rate is the lowest rate the RBI tells the banks to give it to the most valuable customer. Suppose 10%. So the best customer of the bank will get the loans at 10% and not below that. Otherwise, the RBI can put huge penalties on the banks. And what do you mean by GVA? GVA is gross value added. It is the value of goods and services which are mainly contributed by labor plus capital, that is raw material as well as the hard work put in by the employees, and not taxes on product. So the taxes are not included, only labor plus capital. When we take it to the size of the whole economy, it becomes GVA. So nominal GVA growth is when we account the inflation, that is inflation plus total value contributed by labor plus capital. So tightness of monetary conditions is the difference between the base rate and the nominal GVA growth. Now when the banks lend at 10%, if the base rate is suppose 12%, so you will do 10 minus 12, it will come as minus 2%. If the base rate is 15% and normal GVA growth is 11%, it will come as 4%. Okay, so the economy will be less tight. When the economy will be less tight, and when the economy will be less tight, obviously there will be more growth, and when the economy will be more tight, there will be less growth. So let's move ahead. Now CPI inflation will ease between 4.5 to 5% in 2016-17, as I have told you reasons before. So monetary policy could be relaxed in two ways. The monetary policy is how the inflation growth imbalance is balanced by the RBI by lowering or increasing the interest rates or the policy rates. Now monetary policy can be relaxed by easing the liquidity conditions to make them consistent with the current policy rate. Now policy rate is the rates decided by RBI at which they lend to the banks. Okay, suppose repo rate, here it gives, RBI gives to banks. Reverse repo rate, here banks give loan to the RBI. Similarly, there is liquidity adjustment facility. It is a very short-term repurchase agreement that after this many days the money will be returned with interest. This is called liquidity adjustment facility. Now when the RBI is decreasing the policy rate, the banks ideally should decrease their loan rates, which will further lead to easing of the liquidity conditions. Now other way can be the RBI can further lower the policy rate consistent with meeting the inflation target. Okay, so when it further lowers the inflation the policy rate, it can meet the inflation target, as RBI's comfortable inflation target is now 4 plus minus 2%. Okay, that is 2 to 6%. RBI is comfortable with the inflation. Now inflation is also required. Why inflation is required? Because it will gives us sense of profit to the producers. Only then producers will produce more, when they will feel that they are earning better than they are expending. And also the government should support the weakening economic activity and corporate balance sheets by giving them some tax subsidies, etc., or giving some break-even point, that is for startups. Suppose for 3 years they are not going to charge higher amount of taxes, etc. So let's move ahead. Now before dealing with this question that why banks fail in transmission, we should know about the monetary transmission. The monetary transmission is when the RBI reduces the policy rates but the banks don't reciprocate or don't transfer the reduction in the policy rates to the corporate to the loans that they give to their customers. Okay, suppose RBI reduced 125 basis points or 1.25% in the previous 1 and 1.5 year, but banks reduced only 50 basis points. So the why the banks are not transferring the reduction in the policy rates in their deposit rates or the lending rates? They are not doing because banks worry that if they cut their deposit rates, customers will flee to small savings, because if the interest on deposits is less in a bank, customer would not like to put their money in the banks. And you should know that most of the banks in most of the money deposit in the banks in the form of FD. 89% approximately the savings are in the form of fixed deposits. So the customers will flee if their banks reduce the interest rates. So the banks recognize this, and therefore also the government has reduced the rates on small saving schemes like PPF, Public Provident Fund, and Kisan Vikas Patra, etc., to make them more responsive to the market conditions. So moving forward, I would just like to tell you that here see in this figure that we can see that the chart that small saving schemes don't always constrain the pass through. For example, the June rate cut was followed by a large reduction in the deposit rates. See here, the June rate cuts. The June rate cuts is policy repo rates is, this is the June rate cut. You are seeing 0.5% or 50 basis points rate cut was there. Now this rate cut was given, but there was no reduction in the deposit rates. You are seeing. For example, when the June rate cut was followed by large reduction in deposit rates, whereas the much larger October cut was barely passed on at all. You're seeing like I'm sorry, this is the June, this is January rate cut, this is the June rate cut. Here we see a straight line, that is deposit rates have not been reduced by banks, but here you see a huge rate cut by the RBI policy rate. There we see the decrease in the deposit rates. So we can say the banks that their theory that they consider these small saving schemes that people will run to small saving schemes and banks will lose the customers, don't validate too much in this case. So it is just a speculation. So if the bank's liquidity conditions are tightened, that banks have less money, commercial banks will be extra cautious obviously about passing on the policy rate cuts, as they will fear that more people can leave their deposits or take their money out from the deposits and invest in some other saving schemes or share market or whatever, and hence banks will lose liquidity. Now in this figure 2 measures the tightness of monetary conditions in terms of quantities. That is, it plots the RBI's provision of funds in the form of overnight and term repos. That is the liquidity adjustment facility in response to banks' demand of liquidity. Now what is liquidity adjustment facility? The liquidity adjustment facility is, by definition, is measure of a demand for liquidity at short term. Okay, suppose banks are in cash crunch and one particular day, so banks borrow from RBI for a very short time period, at the end of which they have to return the money with interest. they suppose the banks took 100 crore rupees. After one day, if the policy rate, that is the repo rate, is suppose 7% for one day, they need to return 107 crores after one day. Okay, because it is under repurchase agreement. That is, first of all, the banks sell bonds to RBI and take 100 crores, and then then banks give money with interest to RBI and take back their securities or bonds. Okay. Now, what I'm saying is, after the June rate cut, banks borrowing under the LAF fell to zero on average. That is, even after the June rate cut, banks were not borrowing under the liquidity adjustment facility. You are seeing here LAF is in blue color. Now this is June. They have cut the liquidity. Okay. But there was very less bank borrowing. See, zero. It is on zero. Here you see. Okay. But the next time when they increased the when the other LAF was decreased, suddenly banks began to borrow again. So this that is it. It wants to say that we can't tell that when banks borrow and when banks don't borrow. It like they consider the demand from the corporates, not the policy rates increase or decrease by the RBI. So in conclusion, what we can say, that what the quantity and price data suggests is that starting in late 2015, liquidity has been tightening even as the policy rates have been cut. So the consequence of that is the market interest rates and exchange rates are higher than otherwise. Obviously, when the global demand is less, so less dollar is coming into our economy. So obviously dollar is less. When something is less, its price increases. That is, dollar appreciates than the rupee. So exchange rates are higher than otherwise, with implications for domestic growth, exports. Obviously, when exchange rate varies, the export and import also varies, and also the health of the over-indebted corporate sector. Suppose the corporate sector has taken a external commercial borrowing, that is from the foreign financial institutions. It has bought the money. When it bought the money, the price was 50 rupees in $1. But that when the time came to return the money, it became 70 rupees. So the corporate has to shell out more money to pay their debt. So it influences the health of the corporate sector. So let's move ahead to the next topic of the medium term fiscal framework. Normally we follow a annual framework. Annual framework is like budget, that is yearly thing. The medium term fiscal framework is of the extent of 2-3 years. 2-3 years, and this the 2016-17 fiscal stance needs to be assessed in two contexts: the short term outlook for growth and inflation that we see quarterly. As you know, RBI divides the growth into 4 quarters, and also we need to see it in the terms of the medium term context. Why medium term? It is because that we have to preserve our fiscal sustainability. Fiscal sustainability is that we should be able to repay our debts. So the government needs to be in a strong position tomorrow to repay the debts it is incurring today. So it needs to be seen to possess this strength. It can only happen when the growth rate is high, when the money will come in an economy, when the exports will happen. So targets to achieve and signal the fiscal sustainability. First of all, the overall deficit, that is the fiscal deficit. What is fiscal deficit? Fiscal deficit is the net commercial borrowings. What is primary deficit? Primary deficit is fiscal deficit minus the interest payments. What is revenue deficit? Revenue deficit is revenue expenditure minus revenue receipts. And what is debt to the GDP ratio? That is debt upon GDP. Okay. So in principle, sustainable ratios are very much time, country and history contingent. Suppose the global scenario is very good. So even if you are in problem, a particular economy is in problem, it can increase exports because demand is huge. It is also dependent upon the country. Developed countries would be more able to invest in their manufacturing, etc., because they have very high standard of social indicators, but not the emerging or the poor countries. And there is also history contingent. Suppose India didn't grow as much as China during the 30 years or so. So China has accumulated huge foreign exchange reserves, approximately $3 billion, not 3 billion, approximately $3,000 billion, and India has only $350 billion approximately. So it can manage the debt more easily. China can manage it more easily. So let's move ahead, talking about the debt to GDP ratio. Now before that, I should refer to the previous slide. The pinning down a relationship between these targets is difficult to do so scientifically, because we can't find exact level to which we have to reduce the fiscal deficit or debt to GDP ratio. Accordingly, countries have often adopted targets established by others. For example, countries in other regions adopted targets of 3% of GDP for fiscal deficit and 60% for the debt to GDP ratio. And these targets have been adopted by the Eurozone economies under the Stability and Growth Pact. Now, what is this Stability and Growth Pact? Stability and Growth Pact is a set of rules designed to ensure that countries in the European Union pursue sound public finance and coordinate their fiscal policies. So let's move ahead to the next slide. Now, debt, obviously the GDP should increase, the growth in GDP should increase, and debt should decline as the ratio. Debt should decline absolutely as well as in the ratio form. So when the debt decline, the economy becomes more fiscally sustainable. Obviously, when they would have less debt to pay, they can concentrate more on the growth, more in the domestic welfare, etc. So they can grow more and they can also easily pay their debts. But there are some impediments as shown here. When we have large annual deficits since global financial crisis in 2008-9, we invested or we expended a lot of money in the economy. That is, we provided money to boost our economy, to reflate our economy, because the global
financial crisis was taking every country within its own hand. That is, it was slowing down the growth in each and every country. So government gave a artificial push to it by spending more and more. But in 2013-14, a sharp exchange rate depreciation happened. A sharp exchange rate depreciation. It was the result of the announcement of the Federal Reserve Bank of USA that it is bringing down its policy of quantitative easing. Where it bought a lot of bonds and injected money in the US economy. So it was taking back this quantitative easing, that is, it was selling the bonds in the market and taking the money back. So the American investors started to take their dollars out of the Indian economy. Because of that, the demand of the availability of dollar in the Indian economy decreased, and hence the demand of dollar increased in the Indian economy, leading to the depreciation of rupee or appreciation of dollar. So therefore, the debt ratio of the consolidated government, that is center plus state, today is nearly 67% after the above two shocks, but it is still higher than the other emerging Asian economies, and hence it needs to be reduced, and therefore we need to take a path of aggressive fiscal consolidation. But you should also note that the PIGS economy in the European Union, Portuguese, Italy, Greece, Spain, all the economies have debt greater than 100% of the GDP. That is more than Greece have the most, like 125% or so. So we have at approximately half of Greece. Okay. So let's move ahead. So what can be the advantages of aggressive fiscal condition? First of all, it will give credibility to the government that the government is doing very well, and also the rapid growth is happening. It would provide ample revenues to the budget, for the budget to spend. So it will help or enable the economy to withstand the reduction in the government demand. Therefore, fiscal consolidation can achieve the 3.5% of GDP target. That is, fiscal deficit should not be above 3.5% of GDP. But there can be some problems. That is, the 7th pay commission will lead to 0.5% of the GDP increase in the wage bill. Similarly, public investment in infrastructure will lead to increase of 2% of GDP spending. Though it is still lower than the other emerging markets, but still it is very difficult to get the money into infrastructure without the help of private sector, because government don't have so much resources. Government also, whatever the government spends in infrastructure, takes loans and spends. So therefore, achieving the fiscal consolidation could prove difficult unless we increase the taxes or cut the expenditures, or we increase the receipts from disinvestment and spectrum auctions. That the disinvestment have not given us very appreciated results or very enthusiastic results, but spectrum auctions more or less have given good revenue to the government. So even the desirability of a strategy of aggressive fiscal consolidation could be questioned. This is because the current environment is fraught with risks. As you know, the global environment is very weak, so it threatens all the engines of India's growth. It would consequently seem important for government to have some insurance that it should not cut down the debts hugely, that is by spending less and less, because the global environment is very gloomy, and if the growth rate falls, it will be very difficult to
bring it back upwards. So government should follow a moderate fiscal consolidation.